There we are. It's about time this thing works with me today. It was messing with me in here. Good morning. Good morning. I'm a bit of a proud Uncle ICT. We just sent our niece off to college. She's been living with us, and she's now officially a freshman. She's going to go live on campus. So it kind of was a little bit of a delay saying goodbye. My wife and her mother and sister and one of the vehicles were all packed up to go take their stuff there. So that was kind of the reason why I'm delayed. A little emotional. Proud of her. Beautiful young black woman, and I believe she's going to be such a success, and I can't wait to see it. So Olivia, when you listen to this later on, just know that I'm very, very proud of you. So today I want to ask some questions. I know some of you like to ask me questions, but I want to ask you some questions. But before we get into it, I want to give you the lay of the land here. That way we can have our levels in mind. So the yellow shaded area here, that is the entire daily volume imbalance. Okay, so I'm going to go back out to a daily chart in a moment, but for now, if you notice, if you bear with me one second, I apologize. I know I'm not that professional when it comes to this live streaming stuff. Still learning, man. Still learning. Yes, I just want to do an audio check real quick because if I start talking and I don't hear myself, it's going to be these Democrat ads. Wasted. Well, there goes half my audience, right? So, okay, I can hear myself talking. All right, so anyway, this level here, the 20,001, that is the rejection block from the daily chart, which you'll see in a moment. This is the full daily volume imbalance. And some of you probably were on the assumption that you had yours filled in before mine. That's because you probably had settlement toggled on your daily chart, and I'll show you what that means in a moment. This is our new day opening gap for today. You see the reference points over here. And then I'll get into the business of all this stuff here because that's going to be an answer to one or two of the questions that I'm going to propose to you. I'm going to leave you with some questions that you're going to have to answer on your own. It's going to be things that's going to be important for you if you're going to be a student here, or if you're contemplating spending any more time watching any of my content or ever coming to my live streams or whatnot. These are questions that I think that are going to be paramount for you. They're not necessarily important for me because I'm convinced. I mean, it is what it is. It's in my hands. I'm showing you. But for students that are here and you're trying to learn how to do this, or you're just sticking your toe in the water to see if there's any reason to do any further investigation, whether or not this is something that's applicable for you. Does it really work? Is there really an algo? I'm going to give you a lot of things today. Also cover live price action as we go. But we started this week off with the expectation of primarily focusing on the foundations to entries. Okay. And it's one thing knowing where the market's likely to go. Then it's altogether something different than simply saying, well, this is where I think it's going to go. And then when it gets there, you feel the warm and fuzzies. It's like, wow, I really saw that coming. And it really delivered. And that's a necessary part of your development. That is not the same thing as knowing when to get into a trade. Now, I have lots of ways to get into a trade. And you watched me do one yesterday that I'm going to try to do my best to explain what it was. But there's certain elements of manual intervention. And I will try my best to try to articulate what that was that I observed yesterday and walk you through the trade, why I did it, and I'll show you what I did in the afternoon as well. So before we can get to understanding where the market's going to go, we have to have a higher time frame lay of the land. Okay, what's it likely to do? And if you remember when we first started this teaching circuit, the 2024 ICT mentorship on YouTube, it's for free. If anybody's selling you these videos, you're a moron. You're paying for it when it's all for free. But I started it with showing you just intraday volatility. So that way you can read short-term highs and lows, relative equal highs and lows, draws on liquidity, time of day studies, and looking at the influence of what liquidity and inefficiencies in price will offer. So that way it gives you an initial affinity for which one do you like more. Meaning that, first question of the day, are you a student or student/trader that's already been profitable using something else and you're trying to just learn something here, or you're just a trader and you're just here not really trying to learn, but you just want to compare notes? Are you a trader that is influenced by the inefficiencies in price? That means like these single passes in price. That's a buy side balance, sell side efficiency. These one singular little areas where we call it as a gap. Do you have an affinity for those where your eye just jumps to them and you either want to trade inside of them as an entry or target them as your terminus where you're reaching for? Or are you a individual that sees the high and you want to draw to that high to get to the buy side just above it, or relative equal highs to get above those highs? Or do you look at lows that are relatively equal or a singular low and try to use that as a basis for your expectation the market's going to drop down just to engage the liquidity below those lows? You're one or the other. I don't care what school of thought you're using as a trade idea or methodology. You're doing one or the other, okay? And if you're not doing that, then you're really just probably trading off of indicators, and the indicators aren't necessarily going to deliver one of those conditions. So you're going to have to come to the conclusion that either you're going to engage price initially to get into a trade idea with a inefficiency, or entering on liquidity. Liquidity is below old lows or a singular low, or above a singular high, or above relative equal highs. That's it. Okay. Now you may be trading inside of a range, and that smaller short-term low or short-term high is a catalyst for you to get into. For instance, like institutional order flow intro drill, which I taught this week. So now you know there's a little bit more elements to it, and that way you can have a foundation to build on. You may start on one school of thought thinking, I want to enter on fair value gaps and target fair value gaps as my exiting strategy. And then all of a sudden, because you understand the principles of liquidity, time of day, when does the market spool, when does the market take off? Like, when's it reaching for something that is, in your opinion, or my opinion, that it's reasonable to take a partial profit to fund the trade, get something out of it, remove risk, and that way you have a free look. Okay, then you're getting paid to see if it works beyond that point, and that's a real good feeling mentally. It's a wonderful place to be in as a trader, where you've taken a partial, you moved your stop to cover costs. There's absolutely nothing, barring a traumatic experience that nobody can really foresee, upsetting that trade. So that way you have a free look and then paid to see the outcome, versus getting into a trade and not knowing what you're going to do and only holding for the best case exit strategy, which to me is too myopic. There is no trader, and I'm considering myself up in the upper percentage of this bracket of people. I can see what price is likely to do. I can time the market. My students have done the same thing. It's transferable information. But I know that I'm not perfect. I'm capable of messing it up. Me, the human part of me, I'll mess it up. I'll either try to outperform my own concepts, or I'll finesse it, try to do something fancy, and either miss the trade because I can't get my limit executed, or I have completely omitted something in the chart that would have otherwise been more salient and obvious for me, but I'm trying to address a concern of a student, or I may sit down in front of the charts and I'm angry about something. Like one of my puppies, she had an accident in our brand new mattress. Just bought a brand new bed, brand new mattress, and my wife let her fall asleep in the bed, and Scout made a mistake and she dribbled. And it wasn't a lot, but I lost my mind over it. So now we got to get another fucking mattress because I can't have that. But when I sit down in front of the charts, if my mind's occupied on something like that and it's revving and revving and revving, I know I'm more prone to make a mistake. I'm more prone to exact revenge, exact my wrath. And I want to have somebody's head on a stick because something's either gone wrong at my house, something's gone wrong with something I planned for. Maybe one of my kids didn't listen, they didn't do something. I'm a human being, just like you. And you're going to have all these influences. So in those instances, the human aspect of ICT, the man, will mess it up. And because I'm not trading off of something entirely automated all the time, I have to make things discretionary. I got to go in and say, okay, I want to trade this, but then I'll make a decision on how many contracts do I want to trade. And if I have anything external stimulating the end result, meaning if I'm angry, I want to have some kind of a victory or something. I can't change the fact that one of my children may have done something that caused me to have to bail them out financially because they've done something they can't afford. They wreck something, their car gets screwed up, and I gotta buy them another one. They need help sometimes, but if they don't do the things I ask them to do or avoid the things I tell them to avoid, and they make that mistake, I get frustrated by it. So it's tapping that rejection block. Let's go out to the daily chart real quick, and I'll walk you through this because we're a couple minutes away from the opening bell. Now, if you look at what we have here, this is my daily volume of balance. This is the one I was using. If you look in the lower right-hand corner, you'll see SET on TradingView. Okay, if you toggle that, see what it does? It changes the volume imbalance. Many of you probably had your volume imbalance set to that. I shouldn't say many of you, I only had a few of them, but I had a couple people leaving comments saying, hey, mine was already filled in. I don't know what you're doing. You're making a mistake. I'm capable of making a mistake, but I'm not going to make that mistake while I'm trading and I'm looking at the levels I'm reaching for. And what I do is, this is the answer to the question, do I toggle the settlement? Because this is basically allowing the TradingView to use the settlement price as the close on your daily chart candles or not. And to answer your question and make it very simple, I'm looking for PV arrays, whether I'm using the settlement price toggled on or off. Now, I'm showing you here, this is what you probably had on yours. That's not a problem. That's not a mistake. It just means that you didn't do this to see the wider volume imbalance that was there. I'm always going to afford myself the range that's a little bit beyond where the initial one was. So if there's a fair value gap, one toggle of settlement used or not used, and it's broader and wider, I'm going to elect to use the wider one. I'm not trying to get the smaller one. I'm going to use the wider one. The same thing happens here. This is the one I'm using. That's what's on my chart, okay? When we traded up to this candlestick right there, remember, this is what I said. Well, we went up to this part, and we had that remaining portion left. And then it traded through it. But volume imbalances are what? Inefficiencies. And inefficiencies are gaps. Gaps are not one and done, filled and forgotten, tossed out with the, toss the baby out with the bathwater. It's already done now. That gap is filled. We're not retail. We don't think like retail. We're not, John Petticoat style of mentorship. We're not trying to do stupid ass backward stuff. Okay, we're not trying to think like street money. We're not trying to think that the algorithms changed because I'm going to rub somebody's nose in it today with that. The idea of toggling back and forth, I see this rejection block. Okay, but the same thing. I want to see where does that candle body go if I toggle it off? And that's why that's my rejection block, because it's the one that's further away. Further away from where, ICT? Well, when it's down here and I'm reaching up for them, these are premium arrays. When price was below this volume imbalance, like that, and we're below it down here, that's a premium array. We want to see it dig into that. Go back and listen to Tuesday's August 13th, 2024 live stream. Towards the end of the live stream, I walk you through the daily chart. Okay, I'm showing you all the levels. The rejection block was the next, then we have consequent encroachment of this wick, and then we have the high where the buy side is. And I said, ultimately, as long as nothing happens in the Middle East, we're probably going to trade up into this inefficiency here. And I'll have to see how we trade in there to determine whether or not I feel convicted enough to go into this high here. Just go back, it's there. Okay, I can't change it. I'm not able to edit anything, but you can see that's where we reached into. Now, we have continuously pressed in, and I told you that it's not likely to be sustained having this many days up without a down close candle. So it's unsustainable. And that's why we had this singular down close candle, which is good. You want to see that. And you want to see, does price respect that? It trades above it, yes. And today we opened, traded down into that candle, and then rallied back up. Where's it reaching into? The rejection block that you toggle here. Now, this is the part that frustrates some individuals, because this is too many parts. This is too many moving parts. Well, listen, folks. You're expecting to be able to walk out of high school, quit university, say, I ain't going to college, I'm going to school of ICT. He's got everything on his internet YouTube channel, and it's for free. So I'm just going to study that, and I'm going to just be a smart money concepts trader / ICT, because it's the same fucking thing. I'm tired of people talking like SMC is something apart from me. That is me. It's just you're replacing my name, ICT, with my concepts, which I dubbed Smart Money Concepts. Wyckoff is fucking not Smart Money Concepts. Okay? It's not. That's a very, very good introduction to how price can move around, but it doesn't give you the details that Daddy ICT is. So Papa's in the house today. We're going to be cooking today. And I'm going to hurt some feelings today, but I want this to be the last conversation I have about this, because I'm tired of seeing asshats in other people's comments, in my comments, sending me emails saying, you're renaming SMC. Motherfuckers, I created SMC. That's mine. It's fucking mine. Look at the banner on my YouTube channel. I'm the creator of this stuff. There's nobody else out there that had these things, these concepts, ever in any of their shit. Never. Find it. It's there. It's there. If it's there, you're going to get it. $5 million. I got a student. It's in my private mentorship. Don't be offended by this, but he's seen some things in Andrew's pitchfork and median lines, and he thinks he's hit a vein of gold. That's not even close to it. But hey, I'm not here to try to disparage. He might find something that gives him a model in that. But that's not what you're seeing here. Okay, I promise you that is absolutely not. The algorithm has absolutely no respect of Andrew's pitchfork or Andrew's median lines. And if you don't ever looked at it, just start investigating it yourself too. That way you have I have 1,300,000 people now looking at Andrew's pitchforks and Andrew's median lines, because if I have all of you looking, nobody will leave a stone unturned. That way we'll all know that ain't it either. Okay. Don't be offended. I'm not going to say your name. You know who you are. And I have one of my user groups that some of my other students kind of like beat him up a little bit. I haven't been aware of all that, but it's apparent that he's been slapped around. But I can see why he would have gotten a little bit of bruising, because he's insisting on that this is pre-ICT, so therefore that's the algorithm. But yeah, I'll invite all of you to that same thing. Look into it, okay, and you'll discover that ain't it either. But if it makes you feel good, do it. You ever see Demon Knight with what was it? The Crypt Keeper. There's a scene in there where the main I guess the demon monster guy. I can't think of his name. His name's escapes. He's not really in movies anymore. I thought he did a great part there, but he goes, if it makes you feel good, do it. Well, in this regard, you're going to waste your time if you're really trying to convince yourself that that's what it is. First of all, that doesn't give you anything, except for it looks like it afterwards. Today, we're going to talk about how it happens, when it happens, and how you can stop watching people that make videos that say, you should stop trading SMC because of this, or don't trade ICT, or don't watch ICT stuff, or don't waste your time with ICT stuff. Because I don't know if you've been here since we started this mentorship, but I have been literally molten lava in motion. I've been scorching everything, burning everything. And today I'm going to be burning down a lot more. Okay. And I'm going to piss people off. It's going to make them make more videos, which is great because it brings them all to my channel so they can see their asses getting roasted. I'm not watching your stuff. I'm getting people sending me comments about this, that, and the other thing. Well, this guy, he made a video that we shouldn't watch Smart Money Concepts, or they changed the algorithm. And there's some smart money concept traps. Okay, we're going to cover all that stuff. I'm going to ask you some questions, and I'm going to give you some supportive detail and examples. And you tell me who the fuck knows what's going on. Okay, I'm not making videos for drama's sake and getting, look at this, I'm going to start a fire so that way I can get some attraction, some traffic to my YouTube channel, because clicks are what makes the money, right? If you need ICT in your videos, either in the title or mentioning my name or my concepts or whatever, you're kind of I don't know what you want to call that. I don't know what that is. It's something that is not worthy of being watched, I'll tell you that. Because every single time, and there's a guy out there that has his entire channel about me, failing fucking miserably still. None of that stuff brings anybody to, oh, yeah, that's right, it doesn't work. What happens is they want to see what I'm going to say in response, or how I'm going to reply to it, or what am I going to do after that? Oh, no. Oh, you really exposed ICT there. And then I come in here and I'm doing this, telling you exactly what's going to happen. Tuesday, where's the market going to go? The bias has been bullish. Where's it going to go? Each one of these individual levels, each one of them are micro targets in that price delivery continuum. Every little fluctuation that goes higher, you're aiming for the next PD array. But if it hasn't changed its underlying direction, if there hasn't been a reversal, has the Middle East turned into a sea of glass? No. There's saber rattling over there. There's some things being lobbed into one country and they're going over there and doing some other things. All that stuff is still going on, but it hasn't really boiled over yet. And when it does, you'll know it. It'll be in the marketplace. You'll see it. It'll be huge downcomes, and we can't always predict that. So that makes me cautious when a move is long in the tooth like this. So we're getting ready to trade into the midpoint of this wick if we continue higher. So let me mark that, and then we'll drop back down lower time frames, and I'll continue with this carnival-like atmosphere. Let me take this off, this off, this off. We don't need that. We don't need that. That's that. And drop down to a 1 minute chart. So there is consequent encroachment on that premium wick. Okay. So if we trade to this above it and come back down and treat it as support, because now we're in the opening. So now we're in the opening range. Opening range, not opening range gap. Opening range gap is this. Sessions to regular. This is your opening range gap. Previous settlement, day session. Here to the opening, first print. Okay, so that's your opening range gap. If we toggle this back to electronic hours, there's your gap. That is the wick's consequent encroachment, midpoint of the wick on the daily chart. It does not need to trade there. But we have a gap here. So this is the highest probable, I was saying this many times before, but this is the highest probable location. When you have a gap, the first thing in my mind is, do we have the ability, the interest, the speed for price to reprice to half of the gap? This is where we closed at yesterday's settlement price using day session hours. That price here is the low of the opening range gap. The first print at 9:30, that's your opening tick on this candle right here. That is the high. They don't change. These levels do not move around. They're not dynamic. But the opening range, which is the first 30 minutes, that is a dynamic range. It can expand throughout the entirety of that 30-minute time frame. Meaning, right now, the highest high is here. So it's this. We have this. See how I can multitask? I can sling shit, talk trash, be a troll, and still come out here and teach you over a live price action. That's amazing. I can chew bubblegum too. I just don't have any on me right now. All right, and this is the lowest value right now. Okay, so this is why, like, I'm not trying to draw these levels on. I'm just watching and referring to them. And every time we make a lower low, I'm watching where we go after that. And if we start turning around and retracing, I'll mark whatever that lowest low is inside of up to 10 a.m. So this is what you're doing every single day. You're monitoring and watching from where we open, what is the highest high and the lowest low that forms until 10 o'clock. So I believe your name is Louisa. You have some numbers before your name. You're usually very complimentary in the comment section, but you asked the difference between opening range gap and opening range. This is what you're doing. So hopefully this has answered your question. If not, ask again, I guess. I don't know. I see you just about every single day, multiple times in the comments. So anyway, the opening range is we're watching. Do we have a fair value gap form? So an inefficiency. The very first fair value gap that forms after 9:30 in this first 30 minutes interval is such a fucking powerhouse. It is such a wonderful secret weapon that I don't want none of you to tell anybody about it. Okay? You keep it between us. If you tell anybody this stuff, they're going to change the algorithm and it's never going to work ever again. You like that shit? It's funny. I love it. I mean, I get people all the time saying they changed the algorithm. Okay, there's a joker on Twitter that said they're going to change the algorithm. It's not going to work anymore this year. No, and no. Okay, no. There are some out there that took my leaked content and made their own mentorship out of it and called order blocks a Wally fucking block. And other ones ripped them off and then they said, no, it's an institutional candle. No, it's this, that, and the other thing. So there's no honor among thieves. Everybody that stole from me has been stealing from each other, and they're all trying to put mentorships together to scratch some money together instead of just simply trading the stuff that they supposedly understand. So what we're looking for is in that first 10-minute interval, which is the opening range. Okay, so let's say it like this. Can you tell I'm having fun? I didn't feel good yesterday when I first woke up. I didn't sleep well. I was excited about the my niece going away to college, but then I was starting to think, what happens if she goes to a party and she puts her drink, because she's very beautiful. Like, she's a very, very pretty young lady. She's very attractive, and I can see if someone else in a college environment like that were to see her and they were not a man of character, they could probably want to do something. And I told my wife, I said, you have to have a conversation with her without trying to scare her. That, if she goes to a party, whatever, to not put her cup down, don't put her drink down, because pieces of shit that have every reason to have their balls cut off and fed their cock for doing things like that to women, it's a possibility. And I don't feel like going to prison trying to find somebody that does anything to her in college. So this is our opening range. So it's a time period. Okay, it's a time period that begins at 9:30 and it goes up to 10 o'clock. That is the real opening range. The algorithm refers to this. It does not look at fucking 15-minute opening ranges. It doesn't look at the first 5 minutes. It doesn't look at the first 20 minutes. It looks at the first 30 minutes. Okay, that's what it does. So what your interest is you want to see what this dynamic range in time is doing. What's the highest high and the lowest low? And the first fair value gap that forms in this first 30 minutes, you want to extend that throughout the entirety of the day. Okay, all the way until 3:45 Eastern time, New York local time. You'll be surprised how often amazing, I'm talking amazing trades will form off that first fair value gap in that 9:30 to 10 o'clock interval, that opening range. I do not want you to take my word for it. Okay. I've taught this in private mentorship. I've taught this and mentioned it in Twitter spaces last year. I think if I'm not mistaken, last spring, I talked about how you can do this. Okay. And because I have so many concepts, like I said, I got 81 of these things, 81 of them, and they're not all just inversions of one thing. They're individual things, and they themselves are invertible. You hear that word? I just coined it invertible. You might have a convertible, baby, but ICT's got invertible. Okay? Come on. Keep up. So right now, this is the lowest low. We want to see, does it expand down through it? The first probable level is that midpoint of the gap, and that gap is the opening range gap. Opening range gap. We'll put that in the middle. Make it real small like that so it's not too obnoxious. My ego is not obnoxious enough. We don't need any more, right? So you're always hunting, and I'm looking for it through not just a 1 minute chart, but I'm looking for it also in a 15-second chart, a 30-second, 30-second, 15-second chart, 45-second chart. These motherfuckers got a lot of nerve calling me right now. Forgot to put this on Do Not Disturb, so now I'll try to get an answer. The 15-second, the 30-second, the 45-second chart, I'm watching that as well. Right now, as I'm watching this with you, I'm just holding a laptop. I'm in my morning room. I have to be where my dogs can see me. Otherwise, they will howl and scream and cry because my wife and the kids are not here. So usually I'm upstairs or I'm downstairs, and they tend to them. So I'm not distracted. Sometimes you probably heard them in the background. But I'm only looking at this through the chart I have expanded right now. So I have no advantage. I have no 12, 13 monitors, spread out in an array of, like Batman's Batcave. Like I don't have any of that stuff. NASA is not being used today. I'm just simply looking at one screen, one time frame, and I'm outlining it. That way, if you use a tablet, like an iPad or a Samsung tablet, which is superior, that is what you'd accomplish here. You're just looking at one screen, and you just have to toggle through and go through your time frames that way. Generally, when I'm actively trying to take a trade, I'm looking at the 15, the 5, the 1 minute, and then I have that matrix template that has all of the 5, 4, 3, 2, 1, and then I have a 45-second chart, a 30-second chart, and a 15-second chart. And I'm looking for the first fair value gap that forms in those time frames if I have a bias. So right away, I want you to think, I've said it before, it's not a panacea. It doesn't mean it's going to work every single time. But whenever you have a gap up, which is where what we have here, we have yesterday's settlement price, and you determine that by going into regular trading hours. That's that price right there, okay? And you toggle that, or not toggle, but you annotate it, and you annotate the first tick opening price. That is your opening range gap. Now, when it gaps up like that, you want to find the midpoint of that, because many, many times you're going to see it trade to that level. It may afford you a setup. If there is a setup that yields a run from, say, maneuvering something up here off of a premium rate and starts to break down, and you get a fair value gap, say on a 15-second chart or 30-second chart or 45-second chart or the 1 minute, and it affords you a range from wherever that gap is to the midpoint of the gap, that could be your very first like training wheels. So what are you doing in the first 30 minutes? Well, if you don't know how to trade, you should be studying, observing what price is doing, because you don't know what you're looking for. So what can you do with that 30 minutes of time while not knowing how to trade? You study it. You look for the very first inefficiency, the very first fair value gap that forms in that 30 minutes. That's the one that the algorithm is going to like. It's like the center. It's like the centerpiece. Okay, it's the focal point for the daily range. Until we enter a trending day, that fair value gap can be used multiple times for multiple trades, both directions. And it's like one of the really, I can give it to you and have no fear of it, failing, because it's simply going to be there all the time. No, they're not going to change anything. It's doing something else, but it's not necessary for you to know what that is right now, or ever really. It's just like when you get in your car, if you push the button, if it's a push button ignition, or if you put the key and you turn it, and you got gas and the battery's right and the starter works, the chances are it's going to do what? The motor's going to turn over, and then you're probably going to be able to drive it. How far before you crash? That's their skill set. Okay. But here we're looking at a measurable thing that you can go back and back test, see if there's any truth to it. Because anything I say, I don't want you to take my word for it. I want you to go into the charts and see, play like a detective and say, is this true? Because if it's true, I should have ample evidence to say that this man is telling me the truth, or he's full of shit and I don't ever need to go back and watch his videos. Okay. I want you to be that critical of me, because if it's not obvious in the charts, I want you to say, I'm turning ICT off and I'm going to do something else. But I'm convinced, and I've done this, and this is how I've always taught. I challenge everyone. And sometimes I start fires and say, hey, look, your shit's garbage. And this is what really works. And I know that their audience will be offended by that. And they're going to want to say, well, let me see how much better my stuff is versus his stuff. And then they come and they're like, oh, shit. And then they change jerseys. And they're on Team ICT when it's no Team ICT. It's just them seeing what the truth is and why price moves the way it does. But the mid part of that gap, whether it's an up gap, okay, so this is a premium gap. Why? Because we gapped higher than where we settled. So this is a premium opening range gap. If we gap lower than the previous day's settlement, and we say we open down here, that is a discount opening range gap. Okay, very simple. Same thing, as soon as you get the first ticket, 930, you want to throw a fib on that just to get the midpoint. The midpoint has a 7, listen to this bullshit, okay? It's all fake. You're never going to be able to find it in the charts. Promise you. You're going to waste your time if you backtest this. I'm being facetious, but that's what everybody else is going to tell you. All you have to do is go back in time and look at it. You'll see it's there. It's a 70% chance that mid-gap level is going to get hit. Now, that doesn't mean that you're going to get a 70% chance of getting an entry that's profitable, that never got stopped out, that never had drawdown. It's just going to be a straight line run right to the mid part of that gap. It doesn't mean that. What I'm saying is 70% of the time from the opening price to 10 o'clock, that level gets hit 70% of the time. By in and of itself, that right there should have you rock fucking hard. That's Viagra. For someone that understands pattern recognition, you need to have something that repeats, right? You need to have something that is, okay, this is usually, not always, but it's usually likely to pan out. If you can have something that offers and affords you the opportunity to have that much frequency, how many times does the market open up every week at 9:30? How many opportunities do you have of that? 5, right? So you have 5 chances to go in every single day. If we gap higher or if we gap lower, you can do this drill. You can watch it, you can measure it, you can see it. And then what will happen is in the beginning, you won't see a fair value gap. You won't see a setup. You won't see anything that is promoting you the opportunity to get into the trade. And some of you are just going to say, well, I'm just going to get in here and sell short because he said it's 7%. You didn't listen. You didn't listen. There has to be something else in the chart that's technically supporting the idea that it will drop down there, and how to time it. What I'm saying is it's 70% likely between 9:30 and 10 o'clock that if we have a gap higher, or a premium gap in this case, that means that we opened higher than where we settled yesterday. The 50% of that gap, 70% of the time, it's getting tagged. It's going to retrade and reprice back down to it. It can, but you don't need this initially. It can go all the way back down and fill in the gap. Another instance is when you have this measurement like this and you know where you have the higher gap opening and we're in a premium gap. You want to measure where your quadrants are, upper and lower. Many times you'll see it go down and leave a smaller portion of the gap opening, which is really what I love seeing that. Because say, for instance, say we're bullish, okay? Say we're bullish and we think price is going to go higher. What happens if it doesn't go down here and touch the midpoint of the gap? Does that mean that the market is undecided? Does it mean it's weak? Does it mean it's strong? Does it mean it's really, really bullish? It means it's really, really bullish. Because if it can't come back here, because 70% of the time, probabilities and statistically, you can go back and look and see the data. And don't go back like 2 weeks and say, oh, go back, make a real project of it, and then make a project of it going forward. Start keeping records on this information I'm telling you. Really keep the data on it, and you're going to see, wow, there's something there. And then what will happen is you'll see that the examples I've shown where I've entered in before 10 o'clock, it's using this logic. And then I'll have a runner that would hopefully probe any movement below the midpoint of the gap to see if I can get down to the lower quadrant. And then all of a sudden you'll see that's where my other partial was taken. And if I get a gap closure, I'm going to be a little bit higher than the full gap closure because it can do what? In a perfect world, you want to leave a small portion of it open because every gap invite the opportunity that it doesn't completely close in or fill in. That's my main focus so far when I've been teaching gaps in this 2024 is you don't want to see them completely fill in because that's rocket fuel. It's literally like pouring gasoline on a fire that's already burning bright. Okay, you throw gasoline on it by not having a gap or inefficiency fully close in, you have supercharged an idea that you may not be able to see it fleshed out early. Look at it right there. So it's like this guy's fucking got a rabbit's foot up his ass. I'm not that kinky now. So we had this one more time. So where we opened down here, 70% of the time. Now, if you go around, you look around for everybody's, dollar menu mentorships, okay, you're going to get a lot of regurgitated ICT stuff. They're going to try to change the names on things. Now, this is the old high of that volume imbalance. Watch that level as well. That's why it's there, okay? Now, again, for the folks that are asking, what's on your notepad? What do you have in notes that's not on your chart? Because I don't like to have all this stuff on my chart. This is way too busy for me, okay? This almost looks like, and come on. There we go. There's the top of the volume imbalance it traded to, okay? So if you didn't want to take a partial at the halfway point of the gap, that could be hitting it right there. Boom, that's your partial because you want to see it get below the opening range gap half if that's your model. How many times, okay, have you heard someone try to teach something and they'll say, oh yeah, you got about a 70-some chance, or you got an 85%, you got a 90% chance, or you see the scammers online, they'll say ICT model, 100% win rate. Guaranteed, don't watch that, okay? Guaranteed, do not watch that. That's somebody just trying to use my logo and my name for clicks, and they're trying to get someone that's stupid, okay? Because nobody has 100% strike rate. I am not standing out here saying I'm 100% strike rate, okay? I'm telling you that if you can find something that I can prove to you by inviting you to do a free walk forward test, that means now you know the details. You can now walk forward every single day at the opening bell. Did we open higher or lower? Where's the halfway of that gap? Half of that gap is going to get hit before 10 o'clock, 70% of the time. And that means there's something there that could potentially do what? Afford you a drill. Not trade. No, you wanted me to say trade, right? You're not ready for that. You just seen it happen here again. Like every time I come in here and try to show you something and tell you this is what's going to happen, this is where it's likely to do it, and all of a sudden it does it. But there's no algorithm. There's no algorithm. They changed the algorithm. I heard on the street, I got it on good source. Listen, lean in here. I can't say this too loud. People are going to hear it. Listen. They changed the algorithm. Don't tell nobody. We're all fucked. Come on. Listen. I understand the engagements and trying to get people to watch your bullshit. Everything's expensive right now. And nobody wants to buy mentorships because ICT's out here teaching this shit for free. I understand. We're in recession. And ICT's recession for all the mentorship guys. I've caused it. And that's okay. I don't give a fuck. Okay. If you hate me because of that, you'll learn to love me. Okay. Because I'm not going to stop unless I don't feel well. Or my wife says we can't be here together over live charts. But it's better for you to learn it from the source. Okay. Because you're going to see individuals that either sell or have a service that be a part of a community, some kind of Discord horseshit, some kind of Telegram horseshit, some kind of Mickey Mouse bullshit operation, and they're trying to get you to go there and pay them. And my question is, why are they so hard pressed to get you to not watch my stuff? You don't see them doing it anybody else. It's just my stuff. Because they know if you spend time with me, you're going to see that they have renamed my stuff with their dumb shit. And they can't even do it. If someone that's trying to sell you something and they say, I've proven it with 50% strike rate. And then they say SMC is being attacked. It's being targeted. No, it's not. It's literally someone that doesn't know what the fuck they're doing. And they're failing at because they don't know every aspect that the author who's talking to you knows. See, there's a big difference there. Big difference. And this is the time when the conversation where it sounds like this guy's full of shit. He's a bragger. He's arrogant. No, I'm daddy. Okay. And I'm laying down the fucking smack because I'm tired of getting the same regurgitated questions that these influencer boys that literally cannot do it. If you're selling something, you got a 50% strike rate, you don't fucking deserve anybody's fucking money. You deserve a swift kick in the fucking ass. Get on the road, man. If I stood out here and I told you, this is good, and it's going to be right half the time. How the fuck is that an advantage? You have just the same probabilities pulling an ass raising out. Like, seriously, you have no advantage by going to that source. If they're saying half the time they're right. And they can't make the argument saying that smart money, my stuff, okay, that it's being targeted. You saw what I did yet. Wait till you see what I did in the afternoon. You have no idea. If you're saying that, you have no idea. You don't have enough data to make that claim, okay? You haven't even made it into your 30s yet. Some of you haven't even made it to 26 yet that are saying that. But yet you're a mental giant. You've been around the block enough times to know. You don't know shit. We're sitting at the top of the opening range here. Now what we like to do is, since we hit half of the gap, it's come down there, and then now we're at the top of the gap. Do we have the wherewithal to trade above initial high of the day? And if we do, where can it go? That's what that midpoint of that premium gap on the daily chart is, or the wick of that, the halfway point of the gap that we outlined as that wick on the daily chart. That's what that level is. If we take out the opening range high again and close, if we close above it, anytime that we go below here, opens the stage to come all the way back down to a full gap closure. Otherwise, I'm not interested in going short. It would need to do that. So it has to go below here. So it's smart. I'm gonna just make it painfully obvious to you, okay? The things I'm telling you over live price action, I'm using the lowest latency on the live stream. That means as soon as I say it, it takes whatever amount of time it's going to take to travel through the servers at YouTube, cross the bandwidth of our internet, all the way around the world to where your computer's going to receive it or your phone's going to receive it, and then you hear me talk about it. How can I call it back once I say something? How can I make it come back and you not see it? I can't. So because I'm over a 1 minute chart, I'm using a very, very low latency. I'm using the lowest settings on live streaming. I can't make it get to you any faster. I'm telling you before it happens when there's only 3 to 4 seconds delay. So there's absolutely no bullshit fluff in here. I'm telling you what's going to happen before it happens. What is important, what's not important. If we can discern where the market's likely to go, and we can time it, and we can also build some framework around if it's viable, if it's a good trade. We're going to talk about that next week. That's the main takeaways for next week's focus is what are problem things in price action that is going to be important to see, but you're not going to master that soon. It won't be a fast, like, oh, I understand because I watched that part of the lectures. No, it's going to familiarize yourself with the things that are problematic. So when I'm watching price action, when the market's clean, it's easy, like up, down, all around, buy, sell all day long. But when we are in a week like this week, which is what I opened up with on Monday, some of you probably forgot or didn't listen to me, when I mentioned that we are in the week with Jackson Hole Symposium. So Jackson Hole Symposium, let me get this line off here because this is now that. Okay, so that's the opening range low. And then we are trading at 10 o'clock. One more 30 seconds, we'll be at the end of the opening range. So then by that, you know you have the low, and whatever the highest high is, that's your opening range for the day. And you want to do quadrants on that and extend that throughout the entirety of the day. And if you have a macro overlap with that, with time, chances are you have a trade, as long as you know what side of the liquidity you're going to aim for. And I just gave you something that I've never taught that anywhere. Okay, so that's algorithmic. Don't take my word for it. You'll be able to rewind it when you get the recording done. But right now, just pay attention. It's important for you to listen to it twice, because I promise you, if you watch these lectures and you just listen to them one time, you've missed something. And chances are you've missed something really important. Like I mentioned on Monday, I said Jackson Hole Symposium. Day one was Wednesday, or no, day one is today. And Friday's day 2, and then Saturday's day 3. We don't give a shit about Saturday because we're not trading on it. But the week that has Jackson Hole Symposium, and the way you determine that is you simply look at the economic calendar. And it's usually one time a year. And the week that it occurs, that full calendar week, I don't know why it does this, okay? It's just something that I've observed over the years, and I kind of prepare myself for it. I mentioned on Monday that this particular week has a tendency to see price have overlapping price swings, which invites what for a market profile? It invites the seek and destroy. It invites the likelihood of, if you don't have a partial taken, chances are you can be stopped out and have nothing to show for it. Even with like a 75, 100 handle run, it can come all the way back against you and then run again in the same direction, or go back and forth and just chop back and forth. But Jackson Hole Symposium week, always, and you need to have this in your journal. And I still am seeing comments like, I'm having a real hard time. It's been real messy this week. Can you talk about that? I did before the week started trading. I told you that was going to happen. So what I do in my trading, and I'll show you an example of it here in a little bit when I walk through yesterday's trades. I had a lot of people saying, can you tell me what you were doing there? Why was you trading at that time? It wasn't the aspect of the time of entry. It was what I was seeing that I'll articulate it when I get there. So we went above, and now right below this low, we have initial sell side, and buy side is here. So there's inefficiency between the low of the opening range, not opening range gap. We're inside the opening range gap, which is that blue shaded area. But we have sell side here and inefficiency down to previous settlement. So this is the part that's still not that open to inefficiency. So this part is the remaining portion that's lacking any buying and selling during the regular hours. It doesn't matter that we traded here in electronic trading or pre-session. It doesn't matter. Always give the opportunity for the day session, which is 9:30 to 4:15, to reprice into this area, both sides. Since there's no trading between the settlement price and this candle's low, there's no buying and selling booked at all. Zero. I'm not saying there hasn't been, because clearly if we go to electronic trading, you can see that we did trade through it. See that? So it's lacking what? Sell side. Now, here's a big paradigm shift. Since we passed up through it here, it's lacking sell side. So what kind of price delivery, if it wants to go back to the settlement price of yesterday, if it goes below this low, what type of price action would you like to see? What would be the type of price delivery that you would like to see? If it were to go below this low, knowing that we have absolutely traded to the upside through it, so we offered what? Buy side. It's missing what? Sell side. So if it can manage to go below that, would you expect it to go below it a little bit and then shoot right back up real high? Or would you want to see it go below it and drift real slow and lethargic down to the previous settlement price? Or would you expect it to be, boom, one or two candles and get down to the previous settlement price? I would expect it to be quick and sudden to fill the gap. So it provides a means of classification on how price should deliver, not that this is where it could go. Well, that's one part of it. That's one part of the equation. But then you have to have elements of time, not calendar or clock time, but speed. How fast should a price run? How should a price run deliver? Should it be sudden, real quick? Or should it be lethargic and choppy and back and forth, lots of retracements? Or is it trying to get down there real quick? Now, I would expect if it were to trade below that low, to do it quickly. And what else is inside that area? That's today's new day opening gap. So we have a new day opening gap towards the low of the opening range gap and the remaining portion here. So we have to watch this low. What happens if it does this? Say it trades down below and starts to come back up a little bit. What is it doing? Well, it could be taking this wick right here, finding the midpoint of it, hit that, and then expand lower quickly. Quicker, like a sudden rush to get down there. Okay, so all of these things are very hard for me to articulate in chapters in a book, because there's so many instances where if I said that and I tried it, I typed it out, I looked at it, I asked, my friends say, look, when you read this, what do you get from that? He goes, I don't know what it means. And I was like, okay, so I have to do certain things in the live, like these things here, like in video. Whether I was doing this mentorship or not, I was going to be putting videos out to help support the trilogy of these books I'm getting ready to give to the community here. But there are some things that have to be communicated by a live medium where you can see it. It's not something that's like stilted. Like here's a static chart. Here's a static depiction of what this thing looks like after it's panned out. That to me, I had a hard time learning that way. And I had no problems buying new books all the time. It just didn't really communicate it well. So when we sit over price action, a lot of you may not like how I'm teaching, but this is going to make much more sense to you when you start doing your own back testing and you have the notes of me talking about what it is that's important, what characteristics price should show and what should it not show. By having that foundation behind you, it supports not just simply the concept, but it supports the questions or concerns you'll have when you're watching it or trying to back test it. You'll think to yourself, yeah, but what about, and then you'll think, oh yeah, the note said that if it does this, this is what usually should happen. So if you have a question that comes to mind, and then you see that you've taken notes, and I'm suggesting to you that this is how it should book. This is how it should behave. These are things that you don't want to see happen. And these are the things that are supporting the idea. And as long as those things are there and they're supporting it, that means that you will grow confident that you have at least gone into that exercise, that drill, that back testing with the right mindset. And you're not trying to just go in and rush to get to trading. Because rushing to get to trading, whether it's with a funded account challenge or with a funded account, you got lucky to get there, or if it's real money, you're not trading with the insight and understanding that you should have if you do it correctly. And you can do it correctly and not take a lot of time, but you're always going to do farther in terms of the learning curve needing to be longer for you if you rush. And it's an oxymoron, really. You think you're saving yourself the time, but you're only increasing. And there it is again, one more time. How many times, man? How many times are you going to keep getting away with it? Damn it, ICT. Oh, I love it. Yeah, smoking yet? They changed the algorithm. You hear that? They changed the algorithm and smart money traps. That's the thing now. That's the buzzwords. Smart money traps. Get the fuck out of here. You fucking love me. You know you love me. You say you hate me online. You leave shit in the comment section. Other people shit, but you love me. You love me. I know you do. So anyway, we have moved to the midpoint or consequent encroachment of that daily volume imbalance. That's that shaded area here, okay? So I want you to think about how you have been given, and I'm not done yet. Okay? Because we got to review yesterday and show you what you didn't understand. Show you some further proof that they've changed the algorithm. And they're targeting my concepts. They're not fucking targeting shit. You all that don't know how to use them properly, you're falling victim to ignorance, is what that is. It's no different than if you looked at a down closed candle and call that a demand zone. And you think that every down closed candle is a demand zone. And that's why people foolishly look at my stuff and they see, oh, it's a supply and demand. No, it ain't. Oh, no, it's not. All you got to do is go through the logic and study it. And it's not anything like it. You're looking at something because you want to be real quick so you can go out and talk, but you can't walk the walk. If you're coming out there with 50% strike rate and then coming away with, oh, well, it used to be you can make lots of money trading with 200R trades. They never took a 200R trade. That was the biggest bunch of bullshit. 200R, 150R, 100R, 80R, 50R. Everybody, what the fuck? Anybody with rudimentary math skills would know that if you're able to do that, here's the math. Ready? In 6.5 months, you're a fucking billionaire. A billionaire. But you're selling fucking Mickey Mouse mentorships. Get the fuck out of here. But they're jumping on the bandwagon because there's a lot of people out there impatient. They think it's easy. They think the person that's going to sell these things to them is going to make it easy and fast. And all they got to do is watch their bullshit, read their PDF. And they themselves have never done that shit they're trying to sell. They've never made a 200R fucking trade. They've never done that. They've never outlined it and fucking executed it where you fucking saw it. It didn't happen. It did not fucking happen. But I'm out here telling you every micro fluctuation, why it should, and giving you the data points. That way you can go forward, watch it going forward. And there's going to be an opening bell tomorrow. Next week, you got 5 more chances to do it again. You'll know right away if what I've said just today holds water or it doesn't. Think. Who are you going to believe? I'm not here to try to defend myself today. I don't need to defend myself. All I can do is look at what I'm doing. Look at what I already taught. Look at my students. Look at who they're attacking. That's all you have to do is see who's attacking. If ICT's in the title or if my logo's in their fucking thumbnail, chances are either they're a student and they're going through the process of learning how to do it themselves, or they're going to sell you something. They're going to sell you something. It's going to be an affiliate link, Use my affiliate link so I can make some fucking money because I'm broke as shit and I can't fucking make money trading. Hello. And then you have their own mentorships. Really? I don't know about you. Okay. I understand the value of a dollar, even though I don't really care too much about price tags. I have a value on money. It holds a special interest to me. I don't love it, but I have an affinity for it. I sure as fuck am not going to go and sign up to somebody's mentorship where they talk like me. How do you know that they've gone through my mentorship, whether it was leaked or they paid for it? How do you know? They're going to say, this right here is mitigated. What the fuck? Mitigated. None of you even know what the fuck you're talking about when you're talking about mitigation. But every single Tom, Dick, and Harry mentor out there uses that word so much. And they don't even know what the fuck they're saying. They have no idea what they're saying. They think when the market returns back to an order block, it's mitigating. That's not fucking mitigation. That's not mitigation. What the fuck? It's redelivery. Okay? So that is what you're supposed to be saying. If you knew what the fuck you're doing, you wouldn't be calling it they're mitigating this order block. Every fucking Tom, Dick, and Harry mentor says it wrong. You are all fucking wrong. All of you are fucking wrong. You got it now? So if they're going to go through the pantomime of pretending to know how to do it themselves, I'm going to teach you better. I'm going to teach you faster. I'm going to shorten it. I'm going to simplify it for you. And they're using my vocabulary incorrectly. That right there disqualifies them because they have no idea what the fuck they're doing. No idea. Then add to it, the author is sitting here every single day explaining it the right way because Caleb is the recipient of it. Now, we trade up to the bottom of the opening range gap. That's the opening range gap below. I'll take that off of there. We don't need that. So, let me take a pause for a second. We're probably going to go to like 10:45 today. Okay? So just give me a little bit extra time. I know you're probably not complaining, but we were supposed to be done by 10:30, but I'm going to need a little bit of time to get into yesterday's discussion. But I want to cover what I did here and teaching and guiding you what to expect and how to use the opening range gap. If you remember, I gave you the lay of the land for the daily chart. Without me saying anything, what do you see in price action? What was offered as a premium array? Where did price repel from and move lower? And where did it go? ICT, you're scared. You're afraid to take a trade. You always do executions. You always do executions and recorded videos. And it's always the Indians. They're all from India. All of you guys must have like a big powwow together. Okay? And you're like, let's all go on ICT's comment section and say this about him. Because then he'll probably start doing it and we can copy him. I'm not going to do that for you. You're going to see me do executions in this mentorship. But I'm not going to do it as a steady diet. I don't need to do that. Okay? That level right there, the 20,001 level. Do you remember what that was? That's the rejection block. Okay? If you go through the core content lessons in the 2016-2017 mentorship, okay, I started that paid mentorship technically August of 2016. And I believe I introduced the rejection block in the 2016 portion of the lectures, but I don't recall exactly what lesson it was. But I think it's month 4. So you can look at month 4, 2016 mentorship. It's on the core content playlists on the YouTube channel for free. Go to the lesson. It's talking about rejection block. Okay. And I have this little line here. I explained to you why it was there. And also you understand that a rejection block can be used as a reversal pattern. That means if we have a high here and we're expecting prices to do what? Gravitate where? Well, we have an opening range gap. So if it can trade to fill the gap or make an attempt to do so, and we're up here, where should the price draw to? Down. Okay, wonderful. Where can it turn to start going down? Well, you have to know your PD arrays. Initial high, that's the opening range high. If it goes above that and spikes through it, which it could have done before it even did all this over here, it could have went up there and hit that wick of the high on the daily chart. Go back and look at how I walked you through the daily chart. It never traded there. So because it failed to get there on this initial run, here's the opening bell, runs up, next candle slightly higher, and starts going back down. Where is it going back below? The rejection block right there on the daily chart. That's the highest up close in that price swing on the daily chart. We failed to get to consequent encroachment of that wick. Is that bullish or bearish? When we have an opening gap, that's a premium. In other words, we had all of this. My mature students have been with me a lot more time. Their gears are turning right now. They're like, what the hell? This is amazing. I know. It gets better. But this opening and rally up and then going right back down below the low and below that rejection block, we couldn't get to the consequent encroachment of that wick. Well, that's intel. That's giving you what? I can't even reach up here for your ICT, so start looking lower. Okay. Well, let's wait for the market to do what? Give us the mid gap. Well, it does that. There goes the whole 70% of the time. It was one more time giving you the proof of it. In this leg here, and it starts to rally back up, it goes right above the rejection block. Go back and look at the lecture lessons. Listen to what I'm teaching there. This right here, that is a turtle soup. But you don't find that shit on Twitter, do you? Romeo, oh Romeo, tell me some bullshit. Sell me a course. Come on, turtle soup me. Come on, Romeo. You've been waiting for your fucking name. It's coming up today, boy. The ass is on fire, ain't it? Shit fire, burn your ass. So, rejection block. It goes above it just enough to reject. Sends it lower, but there's no algorithm. Now, we're sell side, right below the initial low. That low also is just a little bounce off of the old volume imbalance. This ain't support and resistance, and it ain't supply and demand. And Elliott Wave ain't catching this wave. He's still on the beach waiting. This is not harmonic. It's not Wyckoff. It's good old ICT. So the sell side below here is going to draw to that. That right there, from rejection block to sell side, that may be your trade setup. That might be your cup of tea. That may be your magic bullet. I didn't say silver bullet. I said magic bullet, because they can form any time throughout the day, all day long. If you go through all this price action, okay, go through it. What do you see? 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 What is this? Oh, look at that. That right there. That is the very first fair value gap. Let's walk you through it now. Now, for some of you jokers that are here just for talking points to go in your circle jerks on Discord or Telegram or wherever you hang out on Facebook groups. Yeah, remember that time when ICT said this? I was watching, I forgot whose live stream it was. But I'm always watching I usually mute Patrick Whelan because he's really not saying anything important. I'm watching his chat. And one of his jokers in there saying, yeah, fun fact, ICT was bullish at the high. Actually, no, I wasn't. I was calling every individual level. And then when it turned, you would have had multiple partials anyway. And then I was already calling the lower one. So forget about all that. But folks will say, he's pointing at a fair value gap. And because price may go up to it or trade down to it, they think there's going to be an immediate response, because they don't understand there's an inversion aspect to a fair value gap. If we look at this, and some of you that are signing onto it right now, you're like, oh, this guy's talking hindsight again. You weren't here when we were walking through it. I said the very first fair value gap that forms between 9:30 and 10 during the opening range, because there is no 15-minute opening range. Okay? I don't care that you pay $200 for a course. That is absolute horseshit. This is your very first fair value gap that actually runs up into a rejection block with an opening range that has not completely closed in. We did get the halfway of the gap delivered, offering what? Opportunity to see if it can retrace and go lower. If we go above, these are if and then statements. Okay? For computer programmers, if you ever studied computer programming, it makes perfect sense. It provides you logic where you have a recipe. That's an algorithm. Algorithmic thought process is if this, then that. If this, then that. Or else. They're all programming statements. Okay? And when we were trading here, I said, okay, we're at the top of the opening range gap. Once it trades above, it forces, if we trade below here, it will be a full gap closure. So you're watching price here. Now watch. The logic, go back and listen to it when you can watch the recording. Rewind it and play this part over and over and over again. First fair value gap formed. There is no other fair value gap in here. There is no fair value gap in here. That one is it. Now, if that's your fair value gap, and we went back below the opening range gap high, as soon as we do that, that is indicative of what? Seeking that, where the sell side is. And if it's going to go there, it's going to be a full gap closure. If I was short, I would take partials just above the full gap closure. Why? Because sometimes the gap won't fully close, and then you can see it run and take out the relative equal highs. There's logic there. There's rules there. There's guidance, Kimmel. Okay? There's guidance here. There's rules. There's step-by-step processes. There's if, then, else, or statements. All these things have to be there. Just because I'm calling out a fair value gap on Twitter Spaces and price does this, oh, it failed because they're an idiot. If it goes back into the range, it's going to go here. If it's going to go here, it's going to be a gap closure event. So how will we use that fair value gap if that narrative and logic is in play? Wait for it to trade down below it, then trade back up into it. Then, what was I walking you through? How would you want to see price deliver if it takes out that low? Was I talking about that fucking high going up higher? No. No. How do you want to see price trade below that low? Remember, I told you I was going to be asking you questions. I want you to determine today, is there an algorithm or is there not an algorithm? Am I pulling shit out of my ass that has no point in matching it up with price action before it happens? Is there logic that's repeating? Are these statements in these PD arrays holding water? Is it validity behind it? Or is it just I don't know what I'm doing. I'm looking for it to go higher, but it's dropping lower. Or I'm looking for it to go lower and it's going higher. Are you really seeing that? Because I don't believe that's the case. I gave you this low when we were in here. Do we want to see it trade slowly? Do we want to see it go below that low and retrace, go higher? Or do we want to see it trade below it and then accelerate down? Move quickly in a few candles going down. And I said, if it goes below that low, the style and the characteristic of that delivery should be sudden. It should be quick. I don't know. Does that look like it's sudden and quick on your chart? Don't look at my chart. Look at your chart. Even the lay people should be looking at that now. And you should be able to see it right about now or about to be forming. Caleb's probably watching that form now or it had just formed. But all of you that have been watching the stream, you have the benefit of watching real time with 4-second delay what price was doing. Did you hear me waffle? Did you hear me when it was dropping down there? Did you hear me even get excited or hit a climax? Fuck no. My toes didn't even curl up. This is old shit to me. It's old. But some of you you're moist and wet now because you see this stuff working every single day in my hands in front of you. But you're not going to get to this level fast, and no one's going to get you there fast. Okay? No one. They can't do this. Because if they could, they would do this. They want to help you, they will come out on YouTube and give their logic and their insights away for free. But they're selling you a mentorship. They're selling you a seat in a Discord. They're selling you something so they can pay their fucking bills because they cannot do this shit in the real market. They can't do it. If the logic doesn't hold up with me walking you through it one candlestick at a time, not Al Brooks style, ICT style. Okay? I ain't got nothing against that old guy, but this is not his shit. It's not his. And you can keep lining up everybody else. Keep doing it because eventually it causes a buzz, and the people that watch these individuals, they come in and start watching my stuff and they're like, wow, this is some shit. He's a little bit of a callous person. I don't like his language sometimes. He's a little bit arrogant. But wow, this shit really works. Good. That's really what the point is. I'm not here for friends. But you're seeing elements that prove to you they are not changing any fucking algorithm. There is no smart money traps. I literally walked you through it. I walked you through this morning. Where's the first fair value gap? There. Well, what do you do with the ICT? Oh, if it's above it and it's coming down, I'm going to buy it. Well, you don't know what you're talking about. And I've seen that. I've seen other live streamers that are supporting the things that I do, and they're trying to implement the stuff, but you don't know the logic. I was in a young man's live stream the other day. I subscribed just long enough to be able to comment. He put a trade on. It had no logic behind it. It was a little too premature. And I asked this, why there? And he went through the explanation. I told him, I said, annotate your breaker. He annotated the wrong one. And I didn't want to say anything because it would have been rude. But I went back in and I did a trade after leaving his stream using the breaker that he should have been using. And it was just like, took off. But the trade I did yesterday, I mentioned this many times in Twitter Spaces, and I mentioned it ad nauseum throughout mentorship when people were paying me to learn all this stuff here. These are not new PD arrays. They're the same PD arrays that I released and taught in month 4 of the 2016 mentorship. 2016, 2017 is all one mentorship. It was a 12-month mentorship. And I started it in September. I technically started teaching in August. And then in September, it became structured. So that was considered like month 1 content in 2016. And then month 2 was October 2016. It was 8 lessons. And then every single day I was live streaming. And I was doing these types of things. And because individuals were hoping it was going to be me calling trades, getting a stop placed for them, here's my targets, and I made them sign an agreement digitally through Adobe Sign, knowing that it wasn't a signal service, that we would be using a paper trading account as the medium, so that way it's not investment advice. I was protected. And I made them sign over indemnity. It means that there was nothing they could do to sue me because everything they were doing was simply just me giving an opinion about price action. It's not investment advice. They signed that, and they couldn't be a part of it unless they did that. And they reaffirmed every single month they made a payment to me. They set it in a note, and if they didn't send that note with their payment, I refunded their payments until they sent it, or they just didn't continue. So every student that stayed with me has never came forward and said ICT could not call these markets accurately. It's the opposite. And many of them still couldn't accept the fact that what I was giving them was the foundation of how they are going to learn how to do this. I can talk to you. I could sit out here and do trades, but that's not teaching you how to do it. You won't take every trade that I traded in front of you anyway, because some of you want to see it fail so that we can say, ha ha, look at this guy. I'm glad I didn't take his trade. I'm glad I faded him. You'll hear that shit. Oh, I took the opposite trade. You will show us. Record that you faded me. Record that. Show us why you were thinking that, Mr. Goldbach. This bullshit Goldbach stuff. I want to see the people live stream with it. Don't make a pre-recorded video. and say, well, this is, I went against ICT. That's kind of like lowbrow trolling. Be a highbrow troller, okay? Top tier trolling would be, I'm going to go out here and live stream, and I'm going to say what I think is going to happen with the logic that's not my stuff, some other stuff. It could be something else. I'd love to watch it. I can take a good ribbing. I have a sense of humor, whether you realize it or not. I really do have a sense of humor. I don't have thin skin. I can take a good ribbing because nothing anybody else is going to say about me is going to change what I already know, what I've already proven, and I've placed it in other people's hands. And you're learning how to do it. You're learning how to do it. And here's the Sibby high. So we traveled all the way down to the lower quadrant with the bodies of that old, should have been thrown away if you listened to everybody else, volume imbalance. Let's go back out just for a moment. Yeah, I'm probably going to need till 11 o'clock today. Honestly, I don't know how long we're going to go today, but I have to get it off my chest today. I knew it. I love it. Let's keep trolling him. He makes longer videos and teaches more. You're falling into my trap. That's not your trap. That's my trap. I'm looking for any excuse to get out here and talk for a long, long time. All right, so if we toggle this back, you can see that's the volume imbalance. And if we anchor a fib to that, you always want to do this on the time frame that the imbalances are forming. So now we have one with our quadrants, and I'm going to take that extension stuff off because, oh, no, I think that was me measuring that wick, isn't it? Yeah, that's what it is. So we'll take that off there. We don't need that now. The midpoint or consequent encroachment and the lower quadrant and upper quadrant is now toggled. This candle's low right here, the down close one with the long discount wick. That right there, that low is the high of this Sibby. All this one singular candle to that. So in other words, you would see it like this labeled. If I was showing it to you with a naked chart, nothing else annotated, it would be me highlighting this area here. And it would look like this. Okay, and I would just extend it over. So we're seeing the high of that. So since price is above it and we're coming back down, that old array is what kind of array? It's a discount. Price is going to draw to it. It can draw to it. It can draw down to it, go through it, and come back up and treat it as what? A premium array. That's how you work through the PD array matrix that I teach in month 4 content on this YouTube channel in paid mentorship level teachings that I've given to you for free. And there's jokers out there selling them, and you're stupid when you pay for them because I've gifted it to the community. It's for free right on this YouTube channel. I got folks that are asking me, which mentorship should I do? And is one mentorship better than the other? You're going to have to go through all of them to get the full panoramic view. But any starting point, anywhere you start, just get started. But if I'm going to be doing this live right now over real-time price action, it's in my opinion that would be the easiest litmus test. Is there any value? Because if I'm out here live and I'm explaining something and it isn't working, or it's doing completely opposite to it, well, right away, you've saved yourself a great deal of time, right? Try doing that with your mentors. Have them go out there and spend hours every single day for free, giving you the invitation to say if there's any real value to it. Because if there's no value, you can quickly save yourself time, energy, and heartache. You want to spend any more time, you'll never have to pay any money for it, and you can go about your business and whatever. And anybody has an opinion that's contrary to me, then you can join their club. So, 1 minute chart. And here we have the quadrants. Okay. And disregard, I know it's hard to do it, but disregard this new day opening gap for a moment. Kind of like ignore it being there. We have the high of that shaded volume imbalance on the daily chart. This is the upper quadrant to it. Midpoint is this. There's consequent encroachment. It's red. And then you have the lower quadrant level. And then you have the low of it. We traded down. We created the fair value gap right there. And just above a new day opening gap for today. So what does that mean when we're down here? We can go above it. How far? Fill in the fair value gap. I like that because it's laying right on top of the upper quadrant. So are we looking at just a closing of a fair value gap? No. Are we looking for the market to trade right to the new day opening gap and just turn around like that? Because that's what some people have assumed. And they say, oh, new day opening gaps are trash. They go through them all the time. Again, that's the same logic that's going to be held by someone that puts a fucking YouTube video out and says, this is why you should not be trying to use SMC anymore. Because it's being targeted. Listen. If they have something to say about me personally or about my content, all they have to do is step forward and show what works and how this doesn't work. I'm open for it. I'm out here live streaming. I'm not going to stop live streaming because somebody or some other number of people come out and say, this is why ICT is wrong, and they start doing something. I would fucking love that. I want to have a Mount Carmel experience. Come on. Bring me your shit, Bale. I want to see it because I have everything to smoke all of you. I'll call down fire. Come on. I know he'll listen to me, but you're too afraid to come out here and put your stuff out there to the test. You won't do it. You won't do it because you'll have things that don't work. You'll say, well, that's the way because the price is random. It ain't random. I've already proven enough that it ain't random. So if we have this fair value gap in a new day opening gap, we know that it can sweep above it. It need not just trade to it and drop down. No, that's not how it works. Where's the inefficiency? Right there. Do we have something in agreement with it? Just not by a fair value gap alone. What else is in close proximity to it? Inside that volume imbalance, that shaded area, the upper quadrant level is there. Where does it trade to? Boom. And then what does it do? Low, low. Low higher than that low. So what's below that? Sell side. Fair value gap closed? Yes. Bodies nowhere near closing on them, on that level. And where does it go? Down. Sell side. That might be your trade. That might be your silver bullet. Think about it. Roll it back. Let's say you saw this gap. And let's say you bought it because you're trying to figure out how to do this stuff, okay? You're tape reading. You're not buying it per se because you're trying to get a feel for what it is you're supposed to be doing. You're discovering your model, let's say. And say you say, okay, I'm going to try to buy this. And then it goes down and stops you out. Wonderful. That's a wonderful opportunity because then, because of the rules I just gave you, you know that we have a real strong chance that we're going to take this low out. And if it does, then we have even higher probability than the 70% that when we gap higher at the open, that the midpoint gap will be traded to between 9:30 and 10 o'clock. If it takes out that low, we have a 80% chance that it's going to have a 3/4 closure on the opening gap. Opening range gap. So that means we're about right in here. So if it takes that low out, we can have that much of a range. So what happens when we start to rally back up and we see that inversion fair value gap? You already see it failed with your usage of you trying to buy it. And now it's tipped its hand to you. So what are you going to do? You're not going to beat yourself up and say, oh, this stuff doesn't work. You're going to say, okay, well, we went below it now. And the rules state that we went down half of the gap, we hit that, and we rallied, but then we failed at the fair value gap. The very first fair value gap between 9:30 and 10 o'clock. Take a minute for a second. Take a second, okay? You have my permission to click on this right now at work, even if your boss is sitting next to you. Wink at Carl as you hit the thumbs up, because I'm giving you stuff that you have no excuse to be able to find setups in the first hour of trading. You have no excuse now. I've literally pulled back the veil and I've shown you rule-based ideas that are so specific. They're finite. If this, then that. If this, then this. Or if this goes below here, it's going to go back to 3/4 and then you wait to see if it gives you a full closure of the gap. And if it takes out the gap to the downside, which is what it does here, it trades below the low of the gap. Where's it going to trade to next? Well, in this leg here, is there any inefficiency? Fair value gap. Your eyes should jump right to it. What else is there? You can't just have that alone. Support it with something else. Upper quadrant of the volume imbalance. So now you have two things. So where's the liquidity at? If you're going to sell short in there, where's the liquidity? Where's the inefficiency first? Well, you have it right there. But that's not enough to get excited about. So if that's all you saw and you didn't factor liquidity below the lows, that wouldn't be a trade you would take on. But you have a low that's slightly higher than that one. It's too smooth. It needs to be made what? Jagged. Sell short, engage the sell side, be done. Be done. Because you've had now 1, 2, 3 legs lower seeking liquidity on the downside. So we've pressed 3 times into sell side. The market is entering, we got, was it 1043? We're getting close to when the market can have a retracement into opposing liquidity. So we've seen sell off, and no buy side except for this one has been engaged, and this. But we had 3 deliveries into sell side. So it's setting up a potential where we can get a intraday retracement. Even if it wants to keep going lower, it's fine. But you have to measure every single time we engage liquidity. If 3 times we go into sell side, or 3 times we attack 3 successive higher levels of buy side, or 3 successive lowers of sell side, it opens and invites the opportunity for a retracement, for intermediate term retracement. It doesn't mean that you called the low of the day. It doesn't mean it's calling the high of the day. It just means that you need to be aware that you've done this now 3 times intraday. So it can spool the other direction. And many times that sets up a wonderful continuation to go even lower or even go higher. But you have to anticipate that, because I've watched some of my really good streamers, the students are mine. I'm not going to say their name because I don't want to embarrass them. But I've seen them make this mistake. And I don't want to correct them in front of their audience, but hopefully they can hear what I'm saying here and start incorporating it in their analysis. Because the few times that they do it wrong, it's many times because of that element right there, where the market has traded multiple times to take out liquidity 3 times in one direction. Once you get that, you're setting the stage for an intermediate term retracement, or it could be a complete reversal. And the experience is going to determine what that is going to be for you. But most traders, most of my students, don't have that skill set yet, because I haven't taught them until just right now. Okay, so like I said, this is for my son. And since he gave the authorization and wants to have the progress and process of what he's learned and how it's being done, you're all getting to see that. So you're all eavesdropping still. Okay, you're not entitled to any of this information. So I'm telling him, and I'm talking to him saying, look, my students, you think I'm talking to you, Montel, you, Brian, you, Carl. You think I'm talking to you, Melissa, because I'm talking to my son and I have genuine concern and sincerity behind what I'm saying. But I also know that there are people here that are listening and you want to learn. So I'm cognizant of that. I know that, but I'm really speaking to my son, and that's why it feels genuine. But if it has this very first fair value gap here and we trade below it, what's your mindset going to be? Switch to inversion. Wonderful. So first threshold is, where's the midpoint? That's here. Consequent encroachment. Do we want to see it if it's a valid inversion fair value gap? Okay. If it's a valid inversion fair value gap, will it, remember, I'm just going to be asking you questions today. Will it completely overlap? In other words, will it go below it and come all the way back up and touch the high of the old gap? No. And that's exactly what you want. You want to see it fail to close that in as it goes back up. It's leaving a portion of that candle's low and that candle's high. In other words, it looks like this. That's the portion that didn't close in. You may look at these wicks and it causes confusion. You're like, I don't know what he's looking at. I don't get it. I can't see it. I saw an old student from the first group. I'm not going to say your name, but I mentioned I was trying to learn your language the last live stream, and I didn't do very well. But he mentioned in another live streamers that of all my concepts, the one that he didn't do very well with was the fair value gap. And it's because you don't have all of the rules properly applied to using them in price action. I have held back a lot of stuff because a lot of stuff's going to be in the book. And even with me teaching all this, there's so much more to them that make it a fucking science. Like I have PhD technical science behind me. Okay, I am a fucking dean of Glean, the freak show of fucking precision. And when you see it in these books, you're gonna be like, what the hell? No wonder this fucking exactly. That's exactly what it's gonna feel like. But when you have it in your own hands and you start implementing it and seeing it, it's like you're waiting. You're waiting for that knock at the door. Hey, we need you to come with us, like what they did with Mr. Armstrong. And he told him the same thing I'm gonna tell him. Fuck you, you can't have my technology. You ain't gonna get it. You ain't gonna get it. This is the closest thing you're gonna get to it. Okay? So be satisfied with that. But you don't want to see that complete closure because that's a signature that there's an algorithm saying this should close in, but I'm not gonna close it in. And that's a tip off to entities that you're never gonna meet are engaging right then and there. Citadel starts firing. Bang, 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 bang. Starts sending short entries into the marketplace. That doesn't drive price down there. They're speedily rushing to get their fills in before the algorithm spools below that low in this manner, as I indicated before it did so. I'm going to ask you a question. Do you believe when you're watching YouTube and the videos that are being suggested to you, do you believe that there is an algorithm that makes that selection of choices for videos for you to consume? Do you think there's an algorithm that does that, that curates and goes around and collects and saying, this is what I think this person will probably click on, because YouTube will make money when you open it up. They make 40%, if you believe it. They make 40% of every YouTuber's ad revenue. So they're going to do what? They're going to look at what you have been doing. What do you watch? Do you watch all of the certain type of video or genre? Or do you watch one or two videos and you probably watch the first 4 minutes and lose interest and turn it off? And the video is 8 minutes long, but you're not completely consuming it. Any videos you watch the entirety of, that algorithm is saying, okay, this genre, this category of video is what we're going to do. We're going to start pushing that. And its algorithm will go through and see how much watched minutes. And you don't fucking think that the highest minds of this planet that are actively looking to fleece everyone that's willing to step into this casino, that they don't have an algorithm that is going to determine when and what time, how long and how far these prices are going to go up and down? You don't think that that's possible? There's no real one algorithm that controls price. It's the buying and selling. That's what moves price. And the person that said that in a live stream, I faded the motherfucker and caught the big blast off move in the S&P as he said there's no way it was going to take out the high of the day. It's comedy. It is comedy when you see what? People talk like they know what they're talking about, or they have a hard opinion about what you're learning. And when you don't know what you're doing yet, it's very, very influential. It's easy to talk yourself out of this stuff, folks. But you're never going to be able to say, I didn't show it to you before it happened. Explained it in detail, why it should do this or do that. And there ain't nothing you can do. To my beloved student, Andrew's median lines had nothing to do with what I outlined today. Andrew's pitchforks have nothing to do with what I outlined today. With all due respect and adoration and love for you as my student, I'm saying this with utmost respect. What you're trying to do is reach, and there's nothing there for you. Okay, that's not there. Now, we had the market reach up into this inversion fair value gap. It's the first gap inside of 9:30, 10 o'clock. If you're hunting fair value gaps, Caleb, and that's your pattern, The very first one that forms between 9:30 and 10 o'clock, that's the one you want to see because you're going to get first response off that first presentation. Bang! Hits it, leaves it open, drops. Next candle, open, trades up, rejection block, highest up close in that price swing. Just enough to bump it. There. That's algorithmic. Drops aggressively. I'm walking you through this market right here. I say, okay, when it goes below this, how do you want to see price? Do you want to see it go down below it lethargically? Like really, really slow, dribble, 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 dribble? Or do you want to see it just go below that and treat that like a turtle soup? The Wish version of turtle soup, where it goes below here and they think it's going to go up. Or do you want to see it do what? Sudden rush down to close the gap, or very minimum rush to get to 3/4 of the gap closure. And then I say, you want to see it rush and do it in 2 or 3 candles, quickly, sudden, just like that. It's going to be in the recording when you can go back and listen to it, okay? I didn't waffle. I didn't talk about the other side. I gave you the very specific elements. How it's going to deliver. I'm going to ask you a question, okay? Come here a little bit closer. Listen. Do you think there's an algorithm controlling price? Because I heard on the street that they just changed it and they're attacking smart money concept traders. Woo! Yeah, baby. Keep giving me comedy. I fucking love it. Oh, this is so fucking good. Smart money concept traps, baby. please make more videos like that. I'll leave comments so you can troll me so you can get more ad revenue. Keep doing it. Oh fuck, that's so good. Okay, all right. I'm sorry. I'm not fucking sorry. Oh shit. Oh fuck, I need a break. Give me a drink. Oh man. Somebody's asses are getting chopped today. Oh man. I should have sat closer to the kitchen. It's too far of a walk. All right, so when you see it trade up in the inversion fair value gap, that's your proper use of the very first fair value gap. It's changing the state of delivery, just like an order block will. Okay. Order block, we don't want to see it go, and when it's a bearish order block, we don't want to see it trade above mean threshold. We want to see it dig up into it and roll over and go lower. Reverse it for bullish order blocks. We do not want to see it go below mean threshold, half of its range. Why? Because the strength is indicated by its inability, its reluctance to get to the furthest extreme. Which is why, again, this is not supply and demand, okay? There are schools of thought that will say a fair value gap is best filled. And I teach that it's not so. You want to see weakness and failures with these PD arrays. The failure for this candle or any subsequent candle to get to the high end of that fair value gap, to close it in other words, to get all the way back to this candle's low is what I'm saying essentially. A perfect redelivery would be this candle or any other candle trading up into and touching the equivalent low of that candle right there, which would be 19,979.25. As we have this, we have 19,977.75. So we fell short of that, right? To the tune of the range between that candle's high and that candle's low. That's exactly what you want to see, which is the confidence factor that was given to me when we were down in here. I said, how do you want to see it deliver? And I walked you through the choices. It can go below that low here. And this is where every troll was jerking off saying, here it is. Here's where I'm going to go and go on social media in another person's chat and say, I hear his ICT calling both sides of the marketplace, but now it's even worse. He's given three scenarios. Okay. Go back and listen to what I was doing. Do you want to see it go below that low, a little bit short and go higher and reverse? Do you want to see it go below it and just dribble down and go slow? Or do you want to see it go below it and then large candles and speed, just like that? You want to see large candles and do it quickly with speed. That's what price did. Okay. That would be Caleb's entry. That's his model. Not because of anything other than knowing that the gap was here. We failed to get to the consequent correction of the wick that would have been obvious for it to reach up to. We created a swing low. It traded back to mid gap of the opening range gap and then rallied just outside of the opening range gap. Then rejection block here from the daily chart. Is that support resistance? I want to ask you another question. Are you seeing support and resistance being applied here? Has Elliott ever got off the beach yet? Nope. He's beached. He ain't got his surfboard, his wind sail, his airfoil. Okay, he's not. Unfortunately, he ain't out in the water. He's still watching. Rejection at the rejection block. Trades lower, below the gap. Caleb's school of thought will be, I want to see this gap be overtaken to the downside and then offer me an opportunity to get short. At what price? He will use this candle's high, 19,973 and 3/4, minus one tick. That would be what? 19,973 and a half. That means all it has to do is book that high. Theoretically, that one tick difference should fill him. But I'm affording him the luxury of seeing anything inside this gap. I gotta wait for Miss Scout. She's in here trying to find her position in her kennel. If you have a dog, you ever see them walk around in a circle like 20 times before they lay down? Do you know why they do that? They have scent glands in between their paws. And what they want to do is they want to keep walking over this place where they're going to lay at until they smell their own scent. And when they smell it, then they'll lay down. But she's having a real good time. We just bought her a brand new blanket. See what you get here? Extra, no cost. She's distracting me, so I have to give her a chance because it's still. There we go. So the rejection block, we trade above that. We did get the midpoint of the gap. So if we go above the opening range gap here and then come back in, the net low is going to be suspect. So if it's going to take that low out, then we go to 3/4 gap closure and then full gap closure. We also had new day opening gap high and low inside of the opening range gap, that blue shaded area. This is a fucking masterclass, isn't it? Like, seriously, tell me where you see this stuff in a book to this degree. Explain before it happens. Like, think about it. Like, isn't it fun? Hit the thumbs up if you think this is fun and you're engaged and you're learning and you're seeing the details of it, why it's doing certain things. It's not enough to see a fair value gap and think, oh, I know how to do that. You have to have logic. You have to be able to frame narrative, seeing what price is likely to do because of a logic that's placed behind it. And guess what that logic is leaning on? It stems from the understanding of an algorithm that many will say does not exist. So, let me ask you a question, because I said today we're going to be proposing some questions to you. If there is no algorithm, isn't it basically saying a greater feat of mind reading is being accomplished by me, that I can read the minds of every buyer and seller? You never really thought about it like that, have you? Either I am the greatest mentalist in the history of the world, okay, and I can read the minds like Professor Xavier, okay? I'm sitting in here and I'm looking around the whole world and I'm scanning everybody's fucking brain and I can see what everybody's doing, buying and selling, and I'm reading their minds. I can't do that, folks. That doesn't work. That's not real. ESP ain't a real thing. But there is an algorithm, and there's somebody out there that knows what makes it movements higher and lower, when it ticks, when it talks, when it stops, and when it rocks. I know his name. I know where he lives. I know his social security number. How about that? I'm in the know. I know the guy. I know that guy. I know him. Wish I could introduce you to him. I wish you could meet him face to face. I really wish you could. But this is going to have to be enough. So he would take that trade based on that logic. His stop would have to be above consequent encroachment of this wick. Now, why that? Why not the high of that? Because we already had this low, we drop down, immediate rebalance, then it drops. So for someone that is a little bit more scared, or you don't trust that type of stop loss placement, you could use the high. That's fine. But he's going to have this as another frame of reference. He can use the midpoint of that wick and just a tick above that, because it's not going to go back up there. If it were to stop him out right there, then I would use this level here to instruct him to go long. Then it would be reclaimed bullish fair value gap. To get to that midpoint here on that wick changes the whole classification of this being an inversion fair value gap. So he has a rule-based idea that he can learn, not that he needs to do it right away, because he will not be allowed to take two trades. He takes one trade, that's it. One and done. Fail or profit. And whatever the outcome is, that's what it is. Give me 1 second here. Gotta wet my whistle. I'm probably gonna need till like 11:15. Okay. I knew he'd start making long, but it won't be long, I promise. Long would be like 6 hours. But the placement of the entry, I explained to you, one tick below this candle's high, because I want to make sure he gets filled. And he's affording himself the drawdown up to half of this wick plus 1 tick. That's his stop out, okay? If we wouldn't have had this immediate rebalance, then his stop would have to be above there, okay? Simple, very simple guidance, okay? Very rule-based, very specific. It's not wishy-washy. It's continuous logic that stems from what I've already talked about, where the stop placement is for a fair value gap anyway, but I'm augmenting it to fit him and how he can keep his risks smaller. Not that it affords him more than one contract, because he can only trade with one contract, okay? He will be starting with micros because I want to see him implementing it there. And as long as he's consistently doing that, then after a month of doing it there, then he's going to be permitted to trade it with one standard lot or contract of NASDAQ. He will not be trading ES. I want him to trade the NASDAQ. Not because there's more advantages over it. Everything I'm teaching here works in ES. Everything I'm teaching here works in Forex too, okay? I just don't want to be messing around with Forex right now. So many things going on with the dollar. There's a de-dollarization, whether you like it or not. That's what's happening. I told you in the Twitter Spaces last year, all the nations that's doing what they're doing was going to do what they're doing. I told you what the headlines of the newspaper were going to be last summer. It's happening in front of you. And all of that's working towards removing the global reserve status of the dollar. Like, it's on its last legs. So I don't want to be in the currency market in that climate. Okay, so you can clearly see that you can make all the money you'd ever want trading one index. Okay, gold is going to keep going up because, especially if we have a war event thing pop off over there in the Middle East, we'll probably see $3,200 on gold, maybe $3,500 by Valentine's Day. But if we get short on that idea, his partials would be here if he has multiple, but he can't, so he has to annotate that. His next one would be 3/4 gap closure. And when I say 3/4 gap, you probably don't, especially for the folks that are not English speaking, it would be this price here. So selling short here, Below that low, what would be the next threshold to reach for? It would be the 3/4 of the range that makes that opening range gap. So that could be your partial, okay? And the next would be the new day opening gap high, or somewhere in the vicinity between its low and high. And then if it has been enough time for him to build his equity up and he has 1.5 times full margin, 1.5 times the full margin for the NASDAQ, each time he can meet that threshold, he can trade one more contract. That means he cannot over leverage. It's impossible for him to over leverage. He can only take one trade a day. If he loses, he's done. If he makes money, he's done. Dad is calling the shots. So you probably never looked at your trading like that, where you were holding yourself very rigid, saying, I can't let myself do this. You want to be able to be flexible with rules and say, well, ICT said this, but I'm going to do it. ICT says don't trade on Mondays, but this guy says, look at what I made on Monday. Ha ha ha. Show me every Monday. Don't just say the one you did today. Go into your account like I did, TD Ameritrade account, log into it. Show every single day, every single print, every single broker, every broker statement, every one of them. Do it for 3 months. I bet you won't do it. I bet you won't do it. Anyway, for continuation, if he's afforded himself the amount of equity that he would carry more than one contract, he can then wait to see if we can get below the new day opening gap, which is what we see here, and then wait for what? A retracement. We have a fair value gap, and this fib is not that level. Upper quadrant agreeing with this fair value gap. So we're sweeping above. See, we're sweeping above the new day opening gap. Isn't that what I taught when I started teaching in these lectures for the 2024 mentorship? You want to give the algorithm a chance to move around these levels, because there's going to be stops and liquidity, or it will entice traders to chase it. So this type of movement here causes traders to do what? They want to chase it. And if they think they understand fair value gaps, what are they going to do on this little thing right here? They're going to try to buy that right there. And they're going to get their asses handed to them right there. And they're going to walk away thinking what? These fair value gaps don't work, and they're making traps for smart money traders. No, that's an opinion of someone that can't consistently make it work in their hands because they don't have all the information. Which, if I've said this, I've only introduced the concepts. I've only introduced them. There's so much depth to these things. When to use them, when not to use them. And I'm proving that I'm the only real McCoy with them, which proves it's not somebody else's logic, is it? Because if it's something that's been rebranded and renamed, we'll go to that source and just go right to what they wrote about in their books and just parrot that stuff out. And it should match what I'm doing, right? But it won't. And it won't be able to match up to it either. It won't live up to the precision elements. You won't see it. So we have that old volume imbalance. Key levels: upper quadrant, consequent encroachment, which is this red line here, lower quadrant, and then the low of it. New day opening gap. We want to see it do what? Sweep above it, and then provide a means of going short. How can we key off of that? Fair value gap, 3/4, sweeps above, we're in a premium. Where's it go? Sell side, drops down. What is this? Sell side imbalance, buy side inefficiency. So would you look at this frame of reference right here, annotating that low to that high and extend that out in time? Would you do that? You would if you didn't know how to do fair value gaps properly. What is this? What is that? Inversion fair value gap. You're going to see buy side imbalance, sell side inefficiency here when you're in a market that's going lower. You want to see buy side imbalance, sell side inefficiencies be used as future inversion fair value gaps. When I was on Twitter Spaces and I was saying, you want to note this fair value gap and label it inversion fair value gap. And then at a later time, it trades up into it and it repels away from it. And everybody's like, how the fuck did he call that inversion fair value gap before it was a inversion? Because I know what I'm doing. You're listening to the author, folks. I mean, I don't know how else to make it plainer for you. So if you know this logic, you can then, once you wait for them to form, Caleb, you extend them forward. when they agree with another reference point, something else. It cannot be one singular PD array. Minimum 2. 3, you got a lead pipe cinch trade then. What's this red line right here? It's consequent encroachment of the old daily volume imbalance. What's it touching right there? That level. That's also part of this inversion fair value gap. See that? I laughed so hard I gave myself a sore throat. Good. Maybe your ass will shut up. Nope. I'm going to make a long one tomorrow. So the market sells off. Short-term sell side, minor sell side liquidity pool basically, and trades down. We have this low, all part of August 20th new day opening gap. And we have this low. So we have 1, 2, 3 levels that retail is going to see that as what? What does retail see in that? They don't see the new day opening gap unless they're familiar with my concepts, but they're seeing a low, and a low. So technically they're going to view that as a support level. Okay. I don't see that as a support level. I see that as a means of, okay, like a barrier to breach, okay, to break through it. Get, like the door said, break on through to the other side. So we're getting a little close to lunchtime macro. So I would like to see it do, if it's going to do it quickly. And then we can attack maybe the new day opening gap here in this high. If it takes that low out, I would like to see that run for the lunch macro. Lunch macro, again, for those that are wondering what that is, the market tends to retrace again.